I would like to introduce the first speaker to you. We're starting this year with North America, Canada, US, and a little bit of Mexico. And I thought, why is this the first region that we chose? Maybe because of one of the very important elections last week in Alberta, and surprising elections were the supporter of the losing party want to emigrate to Saskatchewan now, so maybe also some concern there, who knows, but I hope the oil still keeps going, the cheap oil keeps going. And of course also chosen this region because this region definitely is a driver in the economies these days. So I'm curious to hear the news from Peter Hall. Peter Hall is the Vice President and Chief Economist of Export Development in Canada. He was with us in prior years, and we're really, really happy to having you again. His topic will be risk trends in North America.
Well, thank you very much for that kind welcome. It's really good to be back again and to address this audience. I'm not so sure about starting off with the election of socialist governments inside of our most conservative province, but I think that we can safely say that they're probably small c socialists in Alberta there, so we're not expecting too much fallout from them. I will say the last time I was in this room, I have to share this little story with you. That front corner of the room is very important to me because it was about 4 minutes before I presented here the last time that I found out that my then boss was appointed governor of the Bank of Canada. So that's sacred ground over there. Just be careful how you walk on that. No, it is good to be with you again. There's a lot to go through. I've got 3 regions to cover inside of about a half an hour, and I already see that the yellow flag is waving at the front here, so I better move ahead. I want to share with you some risks in each of these 3 areas. So we're going to start off with the United States economy. And I'm not really used to talking about risk when it comes to the U.S. because I'm well known for saying that, you know, the U.S. is the engine of the world economy and that there's almost unfettered growth that's happening inside of that economy right now. And so what can we really say about a situation like that? Growth is usually the greatest risk mitigant out there. So if it's taking off, if it's the first place that's actually happening, what can you say about the budding risks or the existing risks that actually occur or are extant inside of this market? Well, where I'm going to start off with is something that might sound completely unreasonable, and that is, you know, what is fueling the growth that's in the U.S. at the moment? This chart is meant to illustrate that not enough houses are being built here at the moment. Demographic fundamentals strongly suggest that the United States market needs 1.4 million new houses every year in order just to keep pace with the demographic rate of household formation inside of the market. And you can see that post-crisis, the rate of building crashed to about 500,000 units and stayed there for 2.5 to 3 years. And what that enabled the U.S. market to do was to absorb much of what occurred in terms of the surplus of houses that were created prior to the crisis when 2.5 odd million were being built every year, 2.2 to 2.4, roughly in that area. So you can see the bars inside of this chart illustrating the extent to which the surplus built up in the marketplace. But in late 2012, early 2013, the market got into equilibrium. And even although the rate of building more than doubled to about 1.1 million units now, it's still underbuilding, meaning every month the deficit is growing inside of the marketplace. We're not talking about a surplus anymore, we're talking about a deficit. So here's a market where there is significant pent-up demand. Now what's significant about this small segment of the economy is that it's a leading indicator of economic activity. What happens inside of here has a lot of stuff that follows inside of its slipstream. And so if this one is picking up, and do the math behind where the market is now and where I think it's going, there's 30 to 40% growth embedded inside of just getting back to normal. And this is a market that never just gets back to normal. It always goes back to supranormal. And so there's more growth that's actually embedded inside of these numbers. Well, that doesn't sound like a risk at all. Well, you look at the marketplace at the moment and how tight it is, and inventories for both existing and new homes are extremely low. and they're getting lower. And if you look at pricing inside of the marketplace, it's starting to revive as well. Now, you look at some of the most recent indicators, and you might have thought, well, the risk that you're going to talk about is nascent slowing. And I just think, no, I'm on the other side of the page. I think in this market here, there is so much pent-up demand that things, the risk is that things are actually going to get unsustainable. I'm getting ahead of myself. The second area where there's strong evidence of pent-up demand, as far as I'm concerned, is consumer spending. Let's start with durables. Every new house actually has to be filled up with stuff that's very expensive. So if the housing market is growing, we say in the next couple of years, between 30 and 40%, all that new stuff that's going into those houses is chained to the same dynamic. So new first-time purchases of appliances and everything that goes into a new home will rise by the same dynamic. And that's a good thing, because you can see inside of this chart here, this is the share of durable goods spending to overall GDP inside of the market. And I think you would easily agree with me that it's still at very suppressed rates. So this is one where there's a lot of upward momentum as well. Now, what would fuel that? Well, something like the continuous rate of monthly employment growth that's happening at the moment, the way the unemployment rate is going down in the United States at the moment. Real wages are now rising, or they're now there in the economy. You know, there weren't real wage increases. Now there are. So over the rate of inflation for the first time since the crisis actually onset. So there's enough fuel for this going on in the US market. And by the way, US consumers have deleveraged themselves quite handily. It's remarkable. I don't think we've ever seen the amount of deleveraging that's actually occurred over the post-crisis period of time. So there's capacity to actually engage in this kind of spending. So where do we go from here? Ooh, my red line somehow got readjusted. It's supposed to be up at the peak there. So that was a formatting thing, and I apologize to you for that. What is this chart saying? Well, this chart is saying that I'm going to go with this thing over here, if you can see that red laser pointer. This was when the world was in absolute frenzy mode. That's when the bubble internationally was on. If you like, consumption in the West was excessive, and that meant that production all over the world was in excess mode in order to keep up with that. And so this is the rate of capacity utilization right across the American industrial continuum. It was maxed out. And the rates of investment were very strong there. But even although those rates of investment were strong, they were using up every iota of new capacity that was put into place. So that's where capacity maxed out. And then the recession occurred, and all of a sudden all kinds of spare capacity. Why? Because they were over-investing. So a plunge in the utilization of capacity. Now what that means, if you flip the coin around the other side, is no need to invest for a long, long time. You're just about the business of using up the spare capacity in the economy. But even although nobody's really writing home to mom about how great the rate of growth in the US economy has been over the last 6 years, guess what's happened? All of that capacity has been used up. Don't get worried about the fact that that little blip at the end is going down. That's a weather effect. Essentially, where America is at the beginning of global growth and having no industrial capacity out there. Now that sounds to me like a risk. Now I've given you 3 points there where growth is about to take off. And we've got a rate of orders inside of the economy that justifies very fast investment spending and no more capacity inside of the entire industrial spectrum. So what's the risk? Well, usually when this kind of thing occurs and you're at the near end of a growth cycle, investment takes off. It just goes bananas, to use the vernacular. And there are a few large macro indicators inside of any economy that respond as quickly as investment spending does. So when this one takes off, it's a hard one to govern. Well, it actually already is taking off. By the way, here's the capacity utilization rate by industry. The auto sector, I don't know how they're managing at the moment because they're producing at 107% of previous peak capacity. And I don't know what that looks like, the bulging in the seams in factories, machinery running red hot or what have you. Whatever picture works for you, that's a crisis situation for them of a different kind. And I think that we get into a crisis situation like this when we've had a long period of nothing and all of a sudden something is happening, and we don't have an investment mentality to keep up with it. We don't have a consumption mentality to keep up with it, and we certainly don't have a housing market mentality either, a growth mentality in any of these areas. So what's actually happening? Well, 1 to 1.5 years ahead of normal schedule, construction put in place is actually taking off inside of this marketplace. Now, that's the rate at which it's taking off inside of these three special areas of the economy, and they're still producing at peak capacity. So they're only just keeping up with what's needed inside of the economy. Why have I said all of this stuff? Well, if this is the case, and if corks are starting to blow off of very particular sectors, very significant sectors of this economy, then I'm worried that this economy does not have enough capacity to create capacity to service all the growth that's coming its way. And that means a number of things, but the key thing it means is what happens to monetary policy in an environment like this? Where does it actually go? Well, if you're waiting and waiting and waiting for Godot to show up, and all of a sudden he finally does, and you're not really ready for it because you weren't expecting it, you've got a big problem on your hands. Monetary policy movements have to be made 12 to 18 months in advance of an inflation event happening to be effective inside of the marketplace. You always have to be out ahead of those things. And I'm seriously worried that the Fed is behind the curve on this, and that the risk inside of this, it's not our base case, but the risk inside of this outlook is that there could be some very swift monetary movements occurring that could be disruptive. There's the withdrawal of quantitative easing that's causing disruption all over the place that accompanies this as well. Somehow, in an economy that's taking off, all that liquidity has to be ring-fenced in a very creative way in order to prevent inflation from taking off inside of the economy, because there's simply too much money chasing a limited amount of goods and a limited amount of capacity out there. So that would, for me, be risk number one in the United States to keep our eyes on, that monetary movements would have to occur very quickly, and that ring fencing around quantitative easing, or the quantitative tightening process, as we like to call it, happens in an orderly way. What else can we say? Well, the greenback is actually on a tear, and some are worried that growth actually might be undermined by all of this. Well, to that I sort of react and say, I'm not as concerned about that undermining growth, because the source of growth in the United States really isn't exports. It's not an export-led economy. In fact, the domestic economy inside of the United States is what's driving the rest of the world. You remember that US consumers are 70% of the US economy, which means by simple math that 13 cents out of every dollar that circulates worldwide originates with the US consumer. They're a motor of world growth. So it's their domestic economy that's actually keeping things going. So some are worried that this currency effect is actually going to undermine things out there. I'm not as concerned about that, because it's not the source of growth. So this is sort of the greatest non-risk, I guess, that's in the presentation. Some are looking at this and saying, okay, well, look at the deterioration of the trade balance. Surely you're wrong. And I think the trade balance has everything to do with the port strike that happened out on the West Coast, and also the weather effect that pummeled growth inside of the first quarter. I think that has a lot to do with the neo-weakening of the US economy. It's a very temporary thing, much as it was last year. Okay, let's quickly go to Mexico. Everybody satisfied with the US outlook? You know, too much growth? Is that a problem inside of an economy? I don't know. Let's debate that in the question and answer period. Really look forward to mixing it up with everybody on that one. All right, Mexico. What do you have to say about Mexico? Well, we can't look at Mexico without looking at oil. And so one of the key long-run risk factors inside of the Mexican market is the declining production of oil. Pemex has been bled by the government as sort of the bank account of the Mexican economy. And as a result, investment hasn't been going into the field, and so production rates have been declining. So along with declining production rates, then we have a situation of plunging world oil prices. That doesn't make any economy that's an oil producer, a net oil producer, very happy. Mexico, by the way, is the 17th largest net oil producer in the world. And so they are net exporting to other countries, and as a result, this is extremely painful on them. This drop in prices, if it stays at $60 a barrel, is actually costing their economy at least $10 billion directly. And so puts a lot of duress on the economy. At the same time, as I say, their production profile is actually going down. And so this is something to keep one's eye on. There are a couple of different effects that we are watching here. Certainly the amount of revenue that is occurring inside of the economy is much, much lower. And given the dependence on welfare and so forth inside of the economy, we're looking at domestic weakening. We're also looking at a significant weakening of currency, which you might say, well, as a net exporting economy, that's actually providing a bit of a buffer. True enough, you know, when you are a commodity currency, your currency is going to ride along the commodity price movements. We feel the same inside of Canada. But the propensity to import inside of Mexico is a problem here. You know, the dependence that Mexico has on the rest of the world for goods and services, principally food, it's a net food importer. This kind of thing is very punishing on regular people inside of the economy. And we haven't seen evidence of it thus far, but one of my key risks outside of the oil spectrum inside of Mexico is the fact that this tends to raise unrest. You know, when the price of basic foodstuffs actually goes up inside of the economy, there are many people who are living below the poverty line, and this is of great duress to them when something like this happens to the currency. We don't see a whole lot of evidence of imported inflation in Mexico at the moment, so thus far they seem to be able to be managing this situation, but we're waiting to see. Oh, incidentally, the plunge in oil prices is also adding some fiscal duress to the economy. They were counting on $81 oil, so $40 oil was a big scare. They had hedged themselves at $76, I think, and change for this year, but that hedge runs out and they don't have a hedge for next year. So Mexico also dealing with the risk of some fiscal declension actually also happening. Well, I put this up here because this is a positive for the Mexican economy that might actually get more positive as a result of what's going on. So we can't just talk about risk. I'm not wired up that way. This is the relative cost of labor inside of Mexico versus China. So you can see that Mexican labor used to cost 11 times what Chinese labor cost way back in the day. And now that number is only about twice. And in fact, some agree that by certain measures, their labor is equivalent with China's, and the current movement of the currency is actually bringing that about more. So no end to the reshoring, I guess, that's actually going into Mexico at this time. And you can see the success that they have had, not just with portfolio investments going in, but with direct investments as well. I think I'm quickly running out of time here, so I wanted to say more about these things, but I do have to get on to my favorite economy in the whole world. Canada is where I live, I love it, and we're very indebted. Which is really lousy, because we have been vaunted as being the economy of the OECD that kept going in such a resilient fashion throughout the post-crisis period of time. And you can see now how we did it. We went to the bank and said, let's just borrow, borrow, borrow. And we are now just a shade under the rate of indebtedness as Americans were prior to the crisis. So that doesn't have me feeling very good, because we consumers in Canada make up 60% of our economy. We're a pretty powerful force there. And so you might think, ooh, you know, let's short Canada. Hold on, you know, don't go there just yet. I've got more bad news for you. Our rate of indebtedness is such that, you know, if we had a 100 basis point increase in interest rates, it would have the same impact on the share that interest payments take up of total income. It would increase, the share would increase as much as when we previously had a 200 basis point increase in our economy. So talk about a group of consumers that are very sensitive to any kind of interest rate increase in the economy. That's why I believe the Governor of the Bank of Canada is quite worried about the sensitivities, and that might have had something to do with the interest rate cut that we saw happen in January. We're not Americans when it comes to housing either. We sort of binged on that over the last few years as well. So as opposed to having a housing deficit, we actually have a housing surplus. And you can see that we're beginning to go into correction mode here. I don't think that's going to be a short, sharp movement like we saw before. I think that's something that's actually happening, and it's real this time. We'll see. What else can I say that's negative? Canadians are always negative. We always beat up on ourselves. That's just cultural for us. So, we sort of have to do this. Although I must brag that our federal government is doing very well at balancing its books, and it believes that in this fiscal year it will do the same. But I can't be too positive as a Canadian. This is how the provinces are doing. And we've had some really big reversals lately. That red ink inside of Alberta is not because the NDP government was elected. They haven't started spending that quickly already. No, that's a plunge in oil prices, and they feel deep fiscal duress all of a sudden. They were publishing, actually, that they were going to be above the line, and oil prices took care of that. But what's the point of this? Well, the risk inside of the Canadian economy here is we've still got provincial governments that need to be in austerity mode. And so they, together with the housing market and consumers, are not actually going to be contributing to growth going forward. So we're sort of losing our halo that we got, in the immediate post-crisis period. So that's a risk to be aware of inside of Canada. We also have an oil-driven currency. We've got an oil-driven a whole bunch of stuff that goes on inside of Canada, and so plunging oil prices don't make us feel particularly good. But what they do for us inside of Canada is, as one of 5 drivers that we've identified of the Canadian dollar inside of our model, they are exerting a whole lot of influence on that now. And so we believe that our currency is going to be weak for some time. That acts as a buffer for us inside of our economy. So even although the plunging oil price is wreaking havoc with certain economies, each of those provinces inside of Canada, Alberta, if you're taking notes, Alberta, Saskatchewan, New Brunswick, and Newfoundland and Labrador, all 4 of those provinces, Newfoundland and Labrador, by the way, is 1 province for note takers, all in quasi-recession mode at the moment as they react to plunging oil prices. But our Canadian dollar acts as that buffer. So the non-energy provinces of Canada are actually on the flip side. That's what's remarkable about our economy. We're in upheaval at the moment because as deep as the duress is on the oil-producing side of the economy, and you want to be aware of that risk, so too is the flourishing that's actually coming to our non-energy manufacturing sector in particular. And so even although we don't have a domestic economy, all of a sudden, as a result of burgeoning demand in the United States and the capacity constraints that we have here, we actually are seeing investment come north of the border. We're seeing much more increased demand for our exports. We have a sector that's offsetting things inside of the economy. But here's the risk in that story. If oil prices is a risk, but it's being mostly offset by the rest of the economy, the difficulty is that plunging oil prices are having an immediate effect on the economy, and we're still sort of waiting for these positive effects to happen on our non-energy manufacturing side of things. And so, anyway, the dollar is actually helping that to get into place. Most people in Canada were sort of planning in the longer term around a parity currency with the US dollar, and that's not actually happening. We've got now a currency that's about 82 cents. We believe it's going to hover there for the rest of the year and rising up to about 84 cents US next year. So manufacturers in Canada just feel like they've gotten this awesome 15 to 20% bonus that's going straight to the bottom line for them. So add up all these factors together. That's how we get a currency forecast like we've got. But the risk right now is that we're in that in-between zone. We haven't actually seen the payback, and we're already experiencing the duress. And so the naysayers, of course, are out there and saying, well, that good stuff is never actually going to happen. And the Bank of Canada took out a 1/4 point of insurance against the eventuality that we may not actually see the benefits of that happening inside of the Canadian economy. Well, for those who believe that nothing is really going on, actually there is, in certain sectors, quite handy growth happening on an inflation-adjusted basis in certain export categories. And we believe that's going to become more widespread as we move through 2015. And so something is already happening. Don't lose all faith in Canada, but we're still in sort of that in-between period of time. This I put up here. This is an EDC forecast of exports by industry. There's way too much information here, but what I want you to do is focus on 2015 and the ups and downs of the numbers, just to show how much upheaval is actually occurring. A 23% drop in energy exports. But you see on the flip side, you know, some of these massive double-digit increases that are partly dollar-related and they're partly volume-related as well. Things sort of settling down as we go forward. We actually see oil prices coming back to the $70 level when we get to 2016. So that bounce enables some recovery to happen inside of that sector as we go forward. How am I doing time-wise? Did I just get the red? Okay, so the hook has come out, and so we're at takeaways. Magically, we're there. So U.S. risk, just reviewing them. Capacity constraints, worries about currency appreciation, unfounded, we believe, but still a risk to the economy, and some up and down, or actually mostly down happening with the trade balance. Temporary risk there. Mexico risks, the ones that we've gone over, oil price upheaval, having a number of different manifestations there. I didn't really talk too much about the reform process, but that seems to be going rather well, actually, against the prognostications of many. The Canada risks, really a domestic vulnerability, as I had mentioned, and the oil price upheaval Canada style, and structural constraints inside of our economy that we didn't really get to, mostly on the labor side. We're running out of labor, that's all you need to know. And that brings us to a conclusion. Thank you very much for your kind attention.